Hey everyone, I'm Sharmila and welcome back to my channel BD Business World, where we break down complex financial concepts into simple, easy to understand explanations. In the past videos, we have looked at the A's and B's of finance, which is nothing but alpha and beta. Today, we'll be looking at the C, that is CAPM. If you are new here, don't forget to like, subscribe, and hit the bell icon for more insightful videos. Now let's get started. In this video, we will look at what is CAPM, how it is used, what are different market anomalies that needs CAPM adjustment, etc. So what is CAPM? CAPM stands for Capital Asset Pricing Model. It is a very important model in finance. It helps investors figure out the expected minimum return on an investment given its risk level. As it is predicting future returns, it can be said to be a forward-looking measure. It is widely used in portfolio management to analyze the portfolio's past return and adjust portfolios accordingly. As we are looking at the past return in this case, it can also be called as backward-looking measure. It can also correctly predict return on macro news days, that is, news that impact macroeconomic conditions. For example, interest rate change decisions, inflation news, etc. It can also help with budgeting decisions. For example, whether a company should pay out dividends or retain the earnings. If a company has less expected return, the investors would prefer dividends as the growth opportunities will be less. For example, lows. But if the company has more returns, they can retain the earnings and invest in growth. For example, Tesla, which is a growth stock. Let's see how we can calculate the expected return on investment using CAPM. The formula is expected return is equal to risk-free rate plus beta into market premium, where market premium is nothing but the difference between market rate and risk-free rate. In this formula, RF is the risk-free rate, which is 10-year average rate of treasuries. Beta indicates the volatility of the investment. You can see that as beta increases, the expected return increases. This shows that more volatile stocks are, it can give more profit, and that is also true for losses as well. Then we have RM here, which is the market return that is written on a given index fund. So let's calculate the expected return for Tesla using this formula. The average risk-free rate is 4.58%, which is 10-year treasury rate, which I got from Y charts. Beta for Tesla is 2.30, indicating higher volatility as compared to market. I got this value from Yahoo Finance. Market risk premium, that is RM minus RF value, comes out to be 5.42%. You can get the market return from any financial website providing such info. Applying these values in the CAPM formula, the expected return on Tesla is 14.9%. Similarly, you can calculate the expected return for investments you are currently investing in or want to invest in. While calculating expected return using CAPM, we cannot blindside certain market anomalies. Anomalies are nothing but the deviation from efficient markets. These are the conditions where we need to adjust the CAPM model to calculate expected return. Those anomalies could be in already developed market or from emerging markets. Let's take a look at some of the examples of anomalies in developed market. Developed market is a market where economy is mature, has strong capital, and a stable political climate. For example, USA. What anomalies can such markets have? So there are multiple kinds of anomalies in such markets, and those are small firm effect, momentum, January effect, post-earnings announcement drift, book-to-market effect, and many more. Let's take a look at what these anomalies mean. Small firm effect. Historically, small firms do better than large firms, but nowadays, size of the company does not matter as much as it used to be 10 years back. But we should still consider this while comparing a small company with a large one. Then there is momentum effect. Usually, companies carry momentum from previous year to next year. If they have done better in previous year, they drift up over a month or two in the next year. If they have done poor in the previous year, it drifts down over a couple of months in the next year. Then we have post-earnings announcement drift or P. This is similar to momentum but applicable for a period when earnings are announced. If the earnings announced are high, the stock will go higher for some days and vice versa. Then there is January effect, where stock prices, mainly for small companies, tend to rise in January due to tax loss harvesting. Then book to market effect. Next, we will look at what the book to market effect is. Book to market effect is where value stocks having higher book to market ratio tend to outperform growth stocks having lower book to market value. So we need to be careful about these factors while calculating expected return using CAPM. Here is the comparison of a value firm versus growth firm. Here the value firm is JP Morgan Chase and the growth firm is Tesla. So you can see the differences here. A value firm is established, stable company with consistent cash flow, whereas growth firm has high revenue and earnings growth potential. Value firm trades at a lower price to earnings ratio, and the price to earnings ratio for JP Morgan is 13.53, whereas for Tesla it is 200, which is way higher. Value firms often pay high dividends, as discussed before, whereas growth firms reinvest profits rather than paying high dividends. Growth potential is moderate but stable for value firms, whereas for growth firm, higher volatility but greater future upside. Value firm investors buy for long-term stability and income, whereas for growth firm, investors buy for capital appreciation rather than stability. Now let's take a look at emerging market anomalies. Emerging market such as India and China. There are certain types of anomalies found in such emerging markets. Some of the anomalies are underreaction to news, seasonality effect, behavioral biases, and many more. Let's take a look at these one by one. Underreaction to news. Emerging markets often experience delayed reactions to earnings reports, policy changes, and macroeconomic data due to lower analyst coverage and slower information dissemination. With social media, this has changed a lot, but it is still applicable. Then there is seasonality effect. This is when, for certain times of the year, the investment shows stronger performance, potentially due to increased consumer spending and optimism. Another anomaly to look for is behavioral biases. Investors in emerging markets tend to exhibit stronger herd behavior, overreacting to rumors or news. This leads to frequent boom and bust cycles. So overall, we need to consider these anomalies while using CAPM model and adjust the beta as required. Let's do a recap of what we have learned so far. CAPM stands for Capital Asset Pricing Model. It's a model used to find expected return on investment. It is both backward-looking and forward-looking measure. We learned about some anomalies from developed market and emerging markets and indicated how we need to be careful about these while using CAPM. I hope this video helped you understand how the model works and how you can use it in investment and decision making. Let me know in the comments if you have any questions or if there is a finance or business related topic that you would like me to cover next. Don't forget to like, subscribe and share this video with your friends. See you in the next one. Until then, keep learning and let's conquer the world.